like to welcome our first speaker, Mr. Saimanohar Prabhu. I request Saimanohar to introduce himself in brief.
I've already done that, so I won't do it again, probably. But so it's all in front of you. So I've been a finance mentor at an incubation center called Symbiosis Center of Entrepreneurship and Innovation at Lovely. In addition to what I told, I've also taken various sessions. I've been interacting with SIBM, SCM, HRD as a faculty, guest faculty for various topics on finance. So today I've selected a topic which is very relevant and has a lot of practical usage in finance. So I don't know where you are all on the finance knowledge, but let me try to give as much as I can today in 45 minutes.
I request everyone to please sit in front of rows, not at the back. Please come.
So before we actually start, I just want to gauge where everyone is on finance so that I can communicate in a better manner. So have you heard of the DCF method of valuation? Okay, so I'll just come down a bit more then. Okay, so this is a very regularly used method in valuation of equity and very widely allowed method by various regulators all over the world. Reason being, it is business specific. But to arrive to the DCF method, so the DCF method is the end result of a concept called as time value of money, which is a very relevant concept in finance. Maybe you may have heard of this concept of time value of money. Can anyone tell me what is time value of money in short? I would like to have it interactive. So if I give you a choice of giving you a lakh rupees today and a lakh rupees after a year, what would be your choice? After a year? You are probably not meant for finance then. No, on a lighter note, obviously you would want it today. Why? Because you are certain that I am in front of you and you will give me that, I'll give you that money. Second is, I know for sure what this 1 lakh is worth. Because after 1 year, you don't know what would be the impact of inflation. So would you be in the same position to buy the goods and services that you can buy today after a year? Maybe no. So that's why this value of money, money erodes over time. So a cash flow today is worth more than cash worth after a year or after N if the amount, assuming the amount to be the same, say 1 lakh rupees. Okay. So inflation is the main reason. So whenever we take decisions in finance, we try to bring everything to constant time value of money. So the concept of constant time value of money is very simple. We have done it in our academics before 10th standard. The formula of compound interest, right? So compound interest tells you what is the value after a period of n or at the rate of interest of 10, whatever it is. The value you have after 1 year or 2 years is reverse worked in the concept of time value of money. You try to find out the value of money as on today. So the process of doing that is called as discounting. So DCF is discounting cash flow method. So I'll be very brief and I want to go to the case study which we have. So just tell me where you find a disconnect and we'll explain here. So this is precisely what we are talking about. Compound interest. So future value is equal to present value into 1 plus r by 100 raised to n. So this is a known concept. Now we just flip it around. Present value is equal to future value into 1 divided by 1 plus r by 100 raised to n. So this is the calculation of discounting. Now there are certain methods in project evaluation. First is the payback method, very loosely used method, not very relevant because it doesn't consider the time value of money. You have where you are trying to find out if I invest say 10 lakh rupees today, I invest 10 lakhs into a restaurant business today, how much time will it require me to recover my money in total? So I say every year I earn 4.5 lakhs, right? So 4.5, so more than 2 years, somewhere between the second and third year, I'll recover my money under the payback method. The problem is you're not using the concept of discounting. So there is a modified version which uses discounting, and you have discounted payback. So you consider time value of money and find out the present value of the cash flows. So the drawback is the method disregards returns after the payback is over. So what happens is there could be a project where initial 3 to 4 years you have very less returns, and after that you have good returns. So you will end up selecting a project which gives you an early payback under this method and disregard what happens after that. So it doesn't cover the entire spectrum of profits over the lifetime of the project. So it is normally not an accepted method. So we have something called as an NPV, and this is again very regularly used concept in finance, net present value. Okay, so method simply considers time value of money and discounts all your cash outflows and inflows earned till the end of the project. Okay, so here the difference is payback and discounted payback and net present value. In discounted payback, you will get the answer as number of years to recover your investment, whereas here you will get amount of profit in today's terms in a project that you will get for a given range of different projects. So net present value is a very accepted method. How do you evaluate? If all the cash flows, that means outflows as well as inflows. Cash flows means what? You are not considering profits here. Okay, just before we go one step ahead, have you all referred to a profit and loss statement in your lives? Yes, you would have seen that. So you have, revenues, operating expenses, operating profit, depreciation, non-operating expenses, overheads, interest, depreciation, tax, and PAT. So this is not PAT. Here we are seeing cash inflows and cash outflows. Now, you all know there is something called as window dressing in financial statements. You have heard this term, window dressing. So where some organizations use methods, policies in such a way that their profit looks good, though the profit may not be there. So projects have to be purely evaluated on cash they generate. Cash means not hard cash, obviously. The inflows and outflows of money that comes into the business have to be evaluated, and evaluated in constant time value of money as on today. So you are making the decision when? Today. So if you are making a decision today, you have to bring all the cash flows to today's value. So something worth 1 lakh after 1 year would be 95,000 worth today, right? Because after 1 year you could buy goods worth 95,000 if you would have bought them today, right? So here you are having a result criteria that if you have a positive NPV, you go ahead with the project. Now, this concept of positive NPV is further going into DCF method of valuation. So we'll take it up once we finish this concept. So there is something called as IRR. So this is a very, again, regularly used concept. So NPV and IRR are co-linked. Now what is NPV? What is the result of an NPV? It's either a positive number or a negative number, right? So if you have a positive NPV, you say this project is good for me, I'm getting money out of it, I'll go ahead and take it up. If it is negative, I won't take it up. Now IRR with NPV is a very good combination. When you do an NPV, you have taken a discounting rate, that X discounting rate. When we come to an example, you will come to much more clarity on this concept. So you use a discounting rate. Arriving to a discounting rate is depending on a lot of factors. So when you say, I am finding out present value of money, that R can be different for corporates, different projects. So, every project has a risk profile. You all would, understand that risk is not same for all projects. So you have to adjust your discounting factor based on risk. You have to Suppose you are doing the same project for different industries, there could be a different risk profiling. So if you are doing a particular project for a industry which is a very new industry, there's a possibility of default from the customer. You will discount it at a higher rate. But if you are doing a project which is very regularly done in the past by you, and you know that this project always is successful, you always get money in time, there is no escalation, nothing, then you will discount it at a different rate. For example, I have discounted a project at 10%. Okay. Now, I told you internal factors regarding industry and all that. There are external factors also. What could be the external factors that can change my discount factor? Are there any external factors? First is inflation. Inflation is yes, exactly. Inflation is the first main factor. So, when you arrive to a discount factor, the build-up is the risk-free rate of the government bond. So 10-year government GSEC yield can be taken as risk-free rate as the inflation benchmark. So second is, if you are dealing with a particular company, you can take the returns that company gives, or that particular company is in a sector which gives a particular returns as market returns as your market premium. Or you can also take deviations of cash flows as a risk premium. So what is deviation of cash flows? You would have had projects done with a particular client earlier. If you have assumed that you will get 10,000 rupees cash flows every year, you are getting 9,000 or maybe 11,000. So standard deviation is how much? 10%. But if the deviation is higher, the risk is higher. So again, you will add a risk premium. So if, say, government rate is 6%, RBI 10-year GSEC rate is 6%. For a higher deviation, you will charge a higher risk premium. So plus maybe 3%. Lower, you may charge plus 1. Fine. So that how you have a discount factor is also a subject matter of a total discussion. So we won't go to it too much, but to understand. Now IRR is that rate, exactly that rate with where NPV becomes 0. So you can also do it in Excel. Is equal to IRR का formula अगर आपने Excel में use किया रहेगा, तो you get IRR without actually doing much hard work. So you can just put here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 and just is equal to IRR, you will get the IRR. Excel helps you a lot. So you are trying to find out your break-even rate of interest. IRR is like your break-even. So what happens is, you have evaluated different projects. आप लोगों ने project decide किया, this 1, 2, 3, 4, 5, 6 projects are there, and you find out what is the rate of return on each project that you're going to do. And if you have a break-even IRR decided, the projects below that are going to be excluded. The projects above that will be taken up. Obviously, money is short. Manpower is short. So you have to allocate the money in the right projects to get the maximum for your shareholders. At the end of the day, किसको खुश करना है? Shareholders को खुश करना है. How will you do that? How will you generate wealth? By taking up projects which give you maximum profit or minimum risk, right? So your ROI is decided, and then you take projects with a better ROI using the NPV method. So profitability index method is a derivative of NPV. So NPV says present value of inflows minus present value of outflows. So you get the number in absolute terms, net present value. Here you get it as an index, present value of inflows divided by present value of cash outflows. So any project with more than one profitability index is accepted. Okay. So here the concept is explained. Any questions in the concept? Yes, please.
So we are talking about the project, or we are talking about the output over the period of the time. What we are talking here, like a cement plant, it takes 2 years to build the cement plant.
Right.
Are we talking about remaining 20 years for the cement plant, or are we talking about the first 2 years of the project?
So the first 2 years is your outflows. For the company who is installing that cement plant, the first 2 years is their cash outflow period. And the plant will have a life. It could be 30 years, 40 years, 50 years, we don't know. So the entire lifespan of the project is what we are considering an NPV, not only the first 2 years.
So, in PMP, the project over when that 2 years is over. The remaining is the product life or maybe
Yes, understood. But for evaluation of projects in finance, you would like to also find out what is the profitability. So you are thinking from the execution perspective. You are a person who is executing the project. I am your customer. So I am trying to find out that for 2 years of expenses that I have paid to the project team or the project company, what am I going to get as returns? So for example, a large engineering company setting up a cement plant for say 100 crores, and for the next 10 years the plant is going to be good. So I need to find out how much is the cash flows the next 10 years based on capacity utilization, based on realization, based on operating costs, how much cash flow I will generate from each year and whether it makes successful for me. And then I will award the contract to you. That's how it is. Understood? Any? Yes?
So how is it?
So I have a simple case study where we can evaluate a small project. A reputed FMCG company is contemplating buying a packaging machine for packing its soap brands. So this would cost the company 35 crores plus additional working capital investment. So 35 crores is the machine cost. Additional working capital means you'll have to invest some additional funds for raw materials, research and development expense, some advances that may need to be paid, some survey expenses and all that. So that is your working capital. With this investment, it is expected that there would be a pre-tax saving of 5.75 crores and 8.5 crores in first and second year. And after that, you will have 8 years of 12 crores pre-tax savings. The company expects machine will have a useful life of 10 years. So I have evaluated 10 years as the, after which you will have a scrap of 2.5 crores. So you will sell it off at 2.5 crores. And you have some additional data given. 25% is the tax rate assumed, because taxation will eat up cash flows, right? And WDV method is depreciation for your asset. So that is the standard of method used. And you have to find out post-tax savings, post-tax cash flows, NPV at 15% discounting and profitability at 15%, index at 15%. So I've just prepared an Excel sheet. I just run you through. And my main motive is to actually have it tweaked a bit rather than just having a look at it. Is this visible or should I increase the font by a bit? Is this better? Okay. So here I have calculated the numbers based on whatever data I have. So my starting point is pre-tax saving. Depreciation, I have used the WDV method, according to which 5.25, 4.46, 3.79, 3.22 is how it is worked out. So you can have a look at the depreciation working, which is just below here. So I have followed the WDV method, very simple. I have used Excel formula. 35, uska 15% is 5.25, 29 is my written down value. So I take it down to the next year, 29.75, 15%. So this is my closing written down value of the asset, that is after 8 years, it is 9.54. So the depreciation number, that is, this is relevant to me for calculating my taxes, because depreciation gives me a tax benefit. So the assets which are used for business, you get a income tax benefit by deducting that from your profits. So here my savings minus depreciations is savings before tax. It is very similar to profit before tax. Profit earned or cost saved is my profit, right? So savings before tax, I have reduced tax at 25% of the savings. 0.50 cut 25%, 4 cut 25%, 8.21 25%, and so on. So I get my post-tax savings. Till here, any issue in the formula calculations? All good? So post-tax savings, I add back depreciation. So this is where my reporting profit ends. Now I want to evaluate a project. Does depreciation lead to any cash outflow? So there is no outflow. So I added back to find out my post-tax cash inflows. So depreciation I have reduced and I have again added back. What is the logic? just to evaluate tax liability. So depreciation gives me a tax shield. It saves my tax. It doesn't lead to any cash outflow, but I've reduced it. So if I've reduced an expense which does not lead to cash outflow, I add it back to neutralize the impact. But why did I reduce it in the first place? Just to calculate tax, right? Otherwise, I could have got the same answer here. If you see, this is my savings pre-tax. I reduce this is the same, nothing else. It comes to the same number. So I am just finding out the depreciation impact for tax calculation. My initial investment or my cash outflow today is 35 plus 5, 40 crores. That was given to me. 35 crores here plus 5 crores. So 40 crores is my outflow. Post-tax sale of scrap. So this is something which could have different interpretations. Okay. So now, what is the sale value of scrap after year 8? After year 8, my scrap can be sold for 2.5 crores. What is my written down value? 9.54 crores. So my book value is 9.54. I sell it for 2.5. So can I book a loss? I will, because it's not there in the assets, I will write it off. So my loss is 7.04. Now is loss good for tax? Loss is bad, but for tax it is good because it saves your tax. So 7.04, I can claim it as a loss on which I will get a tax benefit of 25%. My tax rate is 25%. So I save a tax of 1.76. Do you want me to repeat? See, I have sold it for 2.5. My book value is 9.54. Is this visible? 9.54. So I have booked a loss of 7.04 because I sold it. Now, tax allows me to claim it as a tax benefit is available for short-term capital loss on sale of assets. That is 25%. I have assumed 25% given the tax rate to me. So, post-tax cash flows is 4.26. How is that worked out? 2.5 is what I'll get. Plus, I will save tax of 1.76. So, how will I save 1.76? Because of 25% on 7.04. So, other projects में जहाँ profit हो रहा है, ये project will save me a tax on the taxes that will come on those projects, right? So other projects will make profits. This will make a loss. So I will save net. I will have to pay tax on the net amount. So if I have projects on year 8 and which has given me a cash profit of 50 crores, will I have to pay tax on 50 crores? Just a minute. Will I have to pay tax on 50 crores? No, I will have to pay tax on 50 minus 7. That is 43 crores. So in effect, 7 crores is saving me a tax of 1.76. So 1.76, any cash outflow saved is an inflow. Logic. Any cash outflow saved is an inflow. So 1.76 plus 2.5 is 4.26. Understood? Now I'm going to negate this also. Okay, so alright, so yeah, you had a question?
Can we claim depreciation as well as this loss on sale? Both are having similar effect.
Depreciation can be, if you see, the depreciation has been claimed and the balance whatever is left is 9.54. I am not claiming the same thing again. After that my 9.54 is left over. I am selling it for 2.5 and the balance is a loss. Yes. Coming back to the main calculations. So post-tax cash flows is what I have carried from here. Now I am going into calculation of NPV. Okay. So this is my cash flows that I am saving as inflows. Plus I have taken this 8-year figure, that is 9.26. Now what is this 9.26? If you see the formula, 5 plus 4.26. So what is this 5? Initially I have invested a 5 crore on working capital. Once the project is over, stocks will be realized, advances, deposits will be coming back to me. So all my my investments will be liquidated. So my cash flows will come in from there. So I'm considering all kind of cash flows in that project relevant to that project. Okay. Now, once I do that, I have my total post-tax cash flows including project and recoveries. So this is my cash flows and I discount it using 15% discounting table. So 1.15. So formula is 1 divided by 1 plus R raised to N. So R by 100 basically. So 1 divided by 1.15. I have taken 15% as requested on the question and 0.87 is my discounting factor. So what is worth 5.63 after a year is 4.89 as on today. Similarly, 7.49 is discounted at a factor of 0.76. So we get a value of 5.66. So it's a multiplication. Simple multiplication of 7.49 into 0.76 and so on. So 9.95. So as and when you go forward, the discount factor keeps on coming down. So the certainty of that cash flow is reduced, right? So further the cash flows, you give a lower discounting factor to it, right? So that's why I told you, if once the project is over, when you know where your cash flows are very low, if you take it into the calculations also, the impact as on today's value will be very negligible. So doesn't make sense to do it beyond a period. Here, then I find out the total present value of all the cash flows and I take the addition of all that. Present values comes to 41.34. So this is precisely the total coming here. My investment is 40. So my net present value is 1.34. So it's positive. So today, if I take a call, I'm going ahead with this project. It gives me a decent returns of more than 15%. Because at 15% is my break even. At 15, it has given me a profit of 1.34 in present value terms, not absolute terms, present value terms. Absolute will be much higher, but I have discounted that. And even after discounting, after considering risk of the inflation, project, all other different risks associated, I come to a calculation of 1.34. So this is it. Do we have time? Good. How much time do we have?
We have 10 minutes.
Yes, okay. Fine.
Now we are open for question and answer round. If you have any questions.
Yes.
So in the 9.26, we have considered that the OPEX 5 CR, that is also coming back. Is it in the 8th year?
8th year, you are saying OPEX is?
In the column I-15.
Yeah, that's also considered.
We are saying that we will get our OPEX money back.
No. We will get working capital back. Working capital of 5 plus sale of machine.
Sale of scrap is okay, but how you can say that we are going to get our working, because working capital is like that you are consuming it every year. It is maintenance cost or whatever. See,
the thing is, suppose you are doing 4 projects. Okay? You are investing say 10 crores as working capital for those 4 projects. Now 5th project aap kar rahe ho. 5th project mein you need 5 crores more, right? Once the project is over, say you have bought raw material, you have spent on advances, location, deposits. So all these things, once that particular project is over, your material will get converted into finished goods. Your deposits kept for that project will be recovered, tender deposits or whatever. You will get it back. So just like an outflow of 5 crores, once the project is over, you will get it back. That's why I have considered it as inflow.
But still, I am not clear why we are saying that will be back, because if we are giving a maintenance money to a supplier, that means that is go as an expense. How we can say?
No, maintenance money is an expense when you are calculating savings before tax.
What item we are considering in OPEX?
So OPEX here you will be considering is all expenses for the operations of that particular machine. वो minus करने के बाद you are getting 5.75. So that's already considered. So net savings, pre-tax savings is, suppose वो मशीन डालने के बाद 10 करोड़ आपका सेव हो रहा है, उसमें से 4.25 crores is maintenance, electricity, additional costs, all that, and then net savings is 5.7. So working capital is different. So today I buy materials that will get converted into finished goods, that will be sold, and after the project I'll recover the money. I can also assume that 5 में से 5 पूरा recover भी नहीं होगा. There could be bad debts. There could be machines, there could be scrap of some materials जिसमें मेरे को 20% loss हो गया. 5 का 4 भी कर सकता हूँ. So वो tweaking Excel sheet में कर देंगे.
So that's a assumption.
Yeah.
Can you scroll down please?
Sure.
So that the profitability index.
Sorry. Yeah.
So if I read it correctly, so against 40 crores of investment, I will be getting 41.34.
Okay.
So which is like 1.34 is my net profit.
1.03, 1.34 is your net profit.
Net
Yes.
profit.
Yeah.
So if we do the margin profiling, so it comes to hardly 3.3%.
So 3.3% above 15%.
Yeah.
3.3. Okay.
That's why वो discounting किया ना.
So it will be roughly around 18.
Yeah.
Something.
So if you want to do that, see, you can do one thing. You can take everything into IRR calculations. I can just do this. Convert everything into a Excel table. Okay. Laptop is a bit difficult to operate. You just put it here, huh? Why it's not coming? See, I put the negative figure as 20. So here the project is giving you negative IRR. So if I take here the exact numbers, मैंने just example दिखा है. So if I take all the numbers and if I just put say you'll see that IRR negative coming down. So here it's getting converted into positive. So you can just put all outflow as the first column, first row, and put all this 4.89, 5.66, all that. Scroll down is equal to IRR and suppose select kar degi, you will get the exact IRR. Now you have got a rough number of 18%.
This does not include direct cost.
Which?
I mean that yesterday there is no direct cost.
So that's a net savings. So everything is included. वो net effect है. That I think everyone is getting confused. Is savings is after your net amount earned minus the cost to earn that net savings. So it's a net savings number, net effective.
Perspective of execution. When I want to get the IR of my project, which I'm executing as a project manager.
Yes.
So this illustration, I find it is perspective of the customer when he is going to give the project. So how can I use my data? I mean, see now what I'm tracking monthly, what are my outflows, and whatever the billing I'm doing to customer. So with those figures, I can derive this.
Yes. So you can get monthly outflows, monthly inflows from client, net outflows, net inflows, whatever is the net figure. Just like we got discounting factor for yearly this thing, you can Google and you can find the Excel sheet for discounted factor every month. So if the management decides to do an IRR of a project minimum 15%, you can find the IRR for every month 15% ka and find out the value today. So for your perspective, who is into execution, you will be getting periodic payments every 6 months, maybe 3 months.
Yes.
So outflows will be one column, inflows will be one column, every month on month, net figures, you can get your present value discounting curve.
Thank you.
Yes. Just take his question. Yeah.
Is WDV is the only standard method or other?
You can follow straight line method also.
How it
Under
is decided?
in the Companies Act 2013, both the methods are allowed, SLM or WDV, but for income tax. So I have taken income tax except only WDV. For only power companies, SLM is used, straight line method. Widely used is WDV. Yes, sir.
So here we have considered investment and return on that one based on depreciation and all these things, am I right?
Yeah.
Whatever saving the company will do after installing that machine in terms of if they are outsourcing and they are doing it by themselves, that is not even considered. That's the only.
This is savings after doing it from yourself without actually giving it outsourced. It is exactly this.
But like if you are doing it by outsourcing it, taking X money, and now you are doing it in-house, so that is reduced by 20% Y money. That is not considered here, is it? Or yes,
It's considered. No, so that's the question itself. So there would be a pre-tax saving by making this investment. So you will be saving money on your packaging costs, because instead of giving it to a third-party vendor who would do your packaging, you do it in-house. So after all expenses, you will be having a savings of 5.75 crores. So this is the delta difference. So if you get it done from outside, it would cost you say 100 crores. Now it is costing you 94.25 crores. So you are saving 5.75. So this is exactly what you are saying. We are saving net figure of 5.75 in the first year. Yes.
Yeah, my feeling is pre-tax or post-tax savings. Are you considering or factoring in any risks assessments?
That is considered in the discounting factor. So discount factor can be tweaked accordingly. I think that was the initial start of the discussion where you have higher risk, you will discount at a higher rate. So if you just take a higher risk, for example, say I have considered risk and standard deviation is a measure of risk. Based on standard deviation of variation, I have considered that the premium which I have to use for discounting is say 3%. If I want to take a higher discounting, I can change this. Instead of 15%, I just do it as say 16%. Now you will see that the project is not going to be fruitful at all.
One question here.
Yeah.
In previous slide, we have taken the life of continuous of 10 years. After
Right.
that, we have a scrap value of 2.5 crore. But here we have calculated for 8 years. So 2 years in the previous slide.
That's a question.
And the company expects the machine will have useful life of 10 years.
Oh, probably while making the calculation. So let's change it to 8 years. I'll change the question itself. So, good. You are a good teacher then. Yes. I did it in the calculation assuming 8 years only. I could have extended it for another 2 years also.
So that the book value will
Yeah.
be 0.
He is from revenue assurance.
Yeah.
So that book value will be 0. If we extend for 2 years,
Could be.
book value will be 0.
You can actually do it right away. Just it's all formula based only. So that is the good thing of Excel is you can change the formula. I'll have to. It'll take me 2 minutes, but we can. Do we have time?
Yes, we have another
Yeah, we can have another question then.
We select entire column J and copy it.
Yeah, that could be done.
That is given.
Yeah. And only two columns are here. I don't think anything else here also. Okay, I'll change it and give it to you. Maybe the answer will change a bit then.
Thank you. One more question. So I'm going beyond this context slightly.
Yeah.
So let's say a company wants to acquire another company, a startup. So this discounted cash flow and all, the same model will work, or there are more parameters?
So what happens now? We are going to a totally different topic. But valuation happens with different methods, which is suitable relating to the data available. So as a valuer, when we do valuations in our assignments, if we have inputs that are reliable, we use that method. So there are different methods like startups में अलग-अलग VC method है. Then in comparable companies method are there. Comparable transaction method is there. So these are totally based on having comparable data, and comparable data may not be available for a startup. So again, startup should be in the same domain. It should be having given out data in the open. It would be listed, non-listed. So you are comparing a non-listed with the listed. It could be somewhere outside India. Then geographical differences, currency differences, risk differences. Then you cannot compare. So DCF method is based on certain assumptions which management signs, certifies, say this is what we know, this is what we feel. The valuation will be done based on the DCF. So in DCF method, what actually happens is you just take a combination of 10 projects which you are doing and finding out the value of the firm. Right? DCF method is what is a company? It's a combination of projects only. It may be doing 5 projects, 6 projects. You just add up all the DCF and get the valuation of the company. And to that, if the company has taken debt, so for example, here we got 1 crore. So there are say 5 projects, each one is worth 1 crore. So you have 5 crores. Suppose the company has taken a debt of say 2 crores on the books. So 3 crores is the valuation of equity. Yeah, and suppose another 2 projects can be taken up, and that can also be done if you have fresh infusion of money. So that will be, this 5 crore will be pre-money. And then you try to find out post-money based on adding these two also into the DCF. So you have post-money minus pre-money.
Is there any another question?
Are there any specific guidelines for finalizing the discount rate?
No.
Or factors which can be considered?
So there are no guidelines, but these are all industry practices which are followed based on data of projects in different industries. Right. So cement could be there, sugar could be there, whatever.
So we have fixed budget projects and time and material.
Correct.
So for both the types, we can apply a similar method, or like is there some of the factors we need to change?
So most of the projects where you are using this method, you'll have to actually change every year your calculations based on variables that can change every year. So initially when you select a project, you keep that margin of safety also. So what you are saying regarding additional cost may come up like time and material cost, or if the time may go up, material cost may inflate. All these things also can be considered on an ongoing basis. But when you select a project initially, it is very difficult to scrap it. So then that will be had to put that escalation clause at that level which you want to into the contract. Now one last question.
Yeah.
This question is not related to exactly what we're discussing, but related to finance in terms of your subjects. So when we look at valuation to be concerned, basically Tata Consumer showed interest in buying India, right? With a valuation of nearly 5 million. So now, if you look at it, Haleram it's not a listed company. It is partnership company to my view.
No, it will come into listing. It has put its papers for listing. Yeah.
Yes, but as we
It's a limited company, but
right. So when we do evaluation for such companies, and we a brand like Tata who is already would have gone and discussed the normal also. What parameters or what terms of reference that from a financial aspect they would have considered to see that this valuation that they're trying to look at 5100 would have arrived at that. buying?
Depends.
It's an inquisitive question.
Depends on synergies majorly.
Because Haldiram has nothing to offer in terms of new products. You know, it has been selling this.
See, there are two things. One is, the price is based on how you perceive as Tata as a brand for you in your total. So synergies is one thing, and second is brand value. If you reduce the brand value and if you reduce the value of synergy, the value of Haldiram could be much lower.
No, I'm trying to relate this with these startups who might come with a USP where they would like to, the valuations would be different, numbers.
So
Haldiram does not have its own USP, which is known fact to the customers or for that matter the market. So how would you do the valuation of such organizations to reach up to that state?
See, valuation is again a completely subjective calculation. Okay, it depends. Price is different and value is different. We are going into a different subject, but maybe a minute. Price is what you actually end up paying. So this is what is the price they have decided, but the value could be different. It could be much lower also. Just to beat others, you can go for a higher price. That could be one thing. Second is the value. The price has been built up because of certain parameters that are beneficial to the business of. So, for example, I do not like mangoes, and it is trading at 1,000 rupees a dozen. It's worthless to me. Someone who likes it will pay 1,200. So, it depends on who is the buyer. Is he really interested to buy it? There's an interesting study, maybe we can discuss later on. 97% of Amazon's value is brand value, and 3% is the value as per books of accounts. That was a valuation study done for Amazon. So it's up to you how much you want to give for brand value.
Yes, thank you, sir. It is a good session on project evaluation methodology using the CF. Very quick get-outs from your seminar, Invest Today, not after 1 year. The next one is NPV and IR. Your case study gives us a very insights about how it works in industry and given a quick overview about how you need to do when you're assigning any project or selecting any project. I would like to thank you, and I would like to call our president to felicitate you.
Very much.
Now we have some chapter announcement.
Good morning, everyone. I am Anuradha Jain, VP Membership for Pune Deccan Chapter. And apologies for being late. I had 4 punctures in my tire. So it was a nightmare to get 40 minutes of fixing my car. All right. So as you can see in the slide, we are trying to interact more, understand each other, learn from each other. Guess what is the strength of our chapter today? We are over 1,100 people, and I can actually count you people in one sheet. So imagine the kind of volume of knowledge that we have, and that's exactly why we have established the learning groups for each of the certifications, which is a very focused, laser-focused group for each of us to learn. Somebody is doing project management, somebody is doing program management, portfolio management. Each of that requires a lot of experience and a lot of knowledge sharing. Nobody's perfect. So we have these WhatsApp groups for each of you to connect, learn, share. No piracy. Original, authentic books, please. Because each of the authors has spent volumes of hours making those books, writing those books for us. So let's just spend a little and buy them. All right. After that, we also are looking at a huge amount of interaction. I don't know how many of you all know that I am the quiz master who posts quiz on the page every day. Oh well, I can see more hands because the last time I saw there were very few hands. So this is not rocket science. I pick up a question from somewhere, I give it to you guys, it stimulates you, you come back with the answer. Some people answer because they know it, some people Google it up, some people do ChatGPT, or some people look for the textbook. End of the day, objective is that you should know the answer of the question by EOD. We are 1,100. We don't know How many of us are 5 years experience, 10 years, 15 years, 20, 25, 30? Do you think, I'm 30 years in the industry, I still feel I need a lot to learn. And I will look for someone with more than 30 years, or maybe less than 30 years, but a varied kind of experience. So all of us should connect, learn from each other, and teach us. Because we are not, none of us are perfect. Now, these groups are meant for each of us to learn certifications, volunteer, share your knowledge. I will not take away. You will gain more. It's not a pot of knowledge when shared becomes more, not less. So we need more volunteers. Come up and talk. Let's hear you out. We also have a networking survey which happens very regularly, which is industry specific, skill specific, maybe a success story. Because I know I've been thinking of PMP from 2000, and guess when I gave? 2016. 16 years it took me to spare that 1.5 months to study and give my certification. Whereas I've been doing project management from 97. But I gave my exam in 16. 19 years later. Let's not do that. Let's talk to each other, get the mentorship, and connect and learn. Lastly, I would like to announce, we have an AGM coming up. AGM normally is very boring. But don't you want to know what's happening to your $10? Don't you want to know what's happening PMI Global? Don't you want to know what's happening in other chapters? Don't you want to be part of it? Your voice should be heard. Please join us in AGM, which is happening on the 17th in the same premises on the 5th floor. So can I see some hands? How many are coming for AGM? Awesome! Jay, we have a huge count here. Thank you very much.
So thank you very much, Anuradha, for setting up this awesome. So good morning, all. Yeah, I'm Jay Dolakia, and a couple of my members, board members are here. You should come up and introduce yourself down the line. Apart from these initiatives, what we do, we are also going to start a couple of new initiatives. I think Anuradha will get back to you on details, but I want to keep you posted. We are going back to post-COVID time, and we will be soon coming up with 3 industry groups, where one is construction, automotive, and IT. These are the 3 areas on which we would like to start our special interest group soon, and we would like your involvement into those areas and suggestions, and we would like to take it forward. We would also need you, couple of you are coming for the first time, which is really good news for us. We would like you to volunteer. Whatever times you are spending Saturday morning here, and a couple of us are continuously coming on almost all weekends here, is our volunteering work. So a lot of things are being planned, and I wish that you should join us and spend some time. Not for me or you, but for the society. Right? Couple of social activities are being planned post monsoon, so do join us, and you will be posted on the information. Right? Networking break. Please have a break.